I'm Darren Sugiyama, CEO and founder of Lionsmark Capital, the most transparent premium financing intermediary firm in the life insurance industry. So, if you're watching this video, I'm going to assume that you're either a client that's considering using premium finance life insurance as part of your overall estate plan, or you're an advisor who has a client that's considering this as a potential estate planning tool. In either case, I think it's important to understand the general concept first and then discover whether or not premium financing is a viable solution for you. So first off, the concept of premium finance life insurance might feel foreign to you, but in reality, it's not all that different than what you've done in the past already, using leverage in different areas of your financial life. If you own a substantial amount of real estate, you probably use leverage in the form of a mortgage loan. You probably finance the purchase of your automobiles, and maybe you've even used leverage to expand your business. Now, premium finance life insurance isn't all that much different in the sense that you're using leverage to purchase a valuable, highly appreciable asset. In this case, a life insurance policy. Oftentimes, our clients will use life insurance as a solution for the impending need for liquidity to pay the 40% in estate taxes when their adult children inherit their estate. Typically, this is done using an ILIT or an irrevocable life insurance trust. And this places the asset, in this case, the life insurance policy, outside their taxable estate. So the advantage of using life insurance as the underlying asset is that the contributions exit your taxable estate. However, the larger death benefit is what goes to your heirs tax-free. And that death benefit is what most of our clients use to pay the estate tax on the remaining taxable estate value. Now, financing the premiums oftentimes makes sense for several reasons. Rather than using 100% of your own money to pay the life insurance premiums, you can finance the premiums and pay interest only to the bank. This drastically reduces the out-of-pocket expense in the early years. Now, because each client is obviously different, we custom design each premium finance life insurance arrangement based on the client's net worth, liquidity, risk tolerance, and a number of other unique variables. We have actually 5 different loan models to choose from. In some cases, we'll use a loan model that isn't 100% leveraged, where the client will pay a portion of the premium out of pocket and then borrow the remaining premiums. Think of it kind of like putting down a larger down payment on a piece of real estate and mortgaging a smaller amount. Again, each client is different, so we take all the variables into consideration, including any estate planning you might have already done, including trust work, gifting exemption, unified credits, and any sort of legacy investing platform. So before we get into the different loan designs, let's talk about the basic concept of premium financing first, using a real estate analogy. So let's start off by getting a deeper understanding of what premium financing actually is. I find that using a real estate analogy is the easiest way to understand the basic concept. So in this analogy, we're going to compare buying a property with cash versus buying a more valuable property using leverage in the form of a mortgage loan. So in this example, we're going to use a loan model that's similar to one of our premium financing loan models, not a traditional mortgage loan. Again, this is purely an analogy. So let's say you're going to buy a $10 million property and the seller agreed to receive $1 million per year over the course of 10 years. And let's say you were going to borrow that $1 million annual amount from a lender. In this scenario, you would have the ongoing loan balance, and in a premium finance loan, you could pay interest only on the loan balance. In this case, we'll use a hypothetical interest rate of 5%. So your interest payments would be 5% of the cumulative loan balance in each given year. And over the course of that 10-year period, that would be $2.75 million in interest-only payments paid to the lender. Now, conversely, on the right side of the screen, you could just purchase a $2.75 million property with cash. So if we assume the same cash outlay each year as the interest payment amounts on the left-hand side of the screen, that would be a total of the same $2.75 million out of pocket paid. Now, let's assume that $2.75 million property appreciated at 5% per year. Now, over that 10-year period, the value of that property would increase to $4.4 million. However, on the left-hand side of the screen, if that $10 million property appreciated at the same rate of 5%, the property value after 10 years would be just over $16 million. Now, that $16 million amount is the gross value, but remember, we still have $10 million of debt on that property. So if we back out the $10 million of debt, we have a $6.2 million net value at the end of 10 years, versus only $4.4 million in the lesser value property purchased with the same cash outlay. So by using leverage, we've created over 40% more net value. And so this concept illustrates the basic idea of how premium finance life insurance works. We're going to take a look at 5 different loan models. Each one of our loan models is specifically designed for a very specific type of client. Most premium financing firms only have one loan model, and they attempt to put every single client in that one singular loan model, which really doesn't make any sense and is certainly not advantageous to the client. So I'm going to go through these 5 different loan models, and we'll assume this case study where the client needs $10 million of death benefit. And I'll use the same client parameters in each one of these loan models. So the first loan model is called first dollar financing. In this scenario, the client borrows 100% of the premiums. In this case, $2 million in premium per year over the course of 7 years. The cumulative loan balance obviously is going to be growing as the client is borrowing more premium. And in this model, the client would pay interest only out of pocket each year. Now, in a 100% leveraged scenario, the client would have to post some collateral to shore up the difference between the loan amount and the policy cash value. Obviously, the death benefit is up in the tens of millions at that point, but the cash value in the first 10 years is going to be a little bit lower than the premiums that were loaded into the policy. In this model, we are exiting the loan in year 11, and we're using the appreciated policy value to pay off that third-party lender. In this scenario here, the initial death benefit amount is just shy of $26 million. After we pay the loan off, we see the death benefit hit a low point at just over $10.5 million. And after that point, the death benefit starts to increase over time. And if we go 40 years out, the death benefit hits a peak of $28.7 million at age 89. Now, you may be asking yourself, why do we have to start with so much more initial death benefit to hit a low point of the $10.5 million? The reason is that when we use leverage, after we pay off the loan, the death benefit does decrease, and so we reverse engineer the design to figure out where the low point needs to be, and then we back into what the initial death benefit needs to be to satisfy that low point death benefit need. Now, after the death benefit hits the low point, we see the death benefit start to drastically increase, and perhaps the client doesn't need more death benefit after that point. So we do have a cost recovery model where the client could start taking drawdowns at a certain point, in this case at age 75, and they would start drawing down just over $766,000 per year over the course of 10 years. That would be a total drawdown amount of $7.6 million. Now, why did we design this so that the client recovers $7.6 million? Well, that was the amount of interest that the client would have paid over time on the premium financing loan. So $7.66 million in and $7.66 million out back into their pocket results in a zero net cost. When we take those drawdowns, you'll see the solid green line there represent the ongoing death benefit, even when we're drawing down that $766,000 per year over the course of 10 years. Again, the low point stays above the $10 million client need. And even after we cost recover via the drawdowns, the death benefit does continue to increase after we finish taking drawdowns and ends up just shy of $16 million right at life expectancy at age 89. Now, some clients will take a look at this and they'll say, well, I don't really need life insurance. No one ever left anything behind for me. I didn't have an inheritance. And my heirs are already going to get millions of dollars. Well, that may be true. But I always say, that 40% is either going to go to your kids or it's going to go to Uncle Sam. Most wealthy clients I talk to would prefer that 40% in their estate value go to just about anyone other than Uncle Sam. And if they say, well, I don't want to make my kids overly wealthy, typically they will have some sort of charity that they would prefer to support instead of their kids or instead of Uncle Sam. In either one of those scenarios, our goal is to figure out what is the best way to maximize your current estate value to preserve as much of your wealth as possible. And then you can decide who would be the beneficiary of the majority of your estate. So we're going to compare premium finance life insurance to a non-insurance based investment. If you had a non-insurance based investment, which you probably do already, if you made the same 10 years of annual contributions to this non-insurance based investment, assuming the same gross rate of return that we're showing in the life insurance policy, assuming a certain investment fee amount as well as a certain capital gains tax amount, and the 40% in estate taxes, and assuming the same cost recovery drawdowns that we showed in the premium finance life insurance policy. Now, on the right-hand side of the screen, we see the comparison. The green line represents the ongoing net death benefit of the premium finance life insurance policy, again, with the cost recovery drawdowns, and the blue line represents the value of the non-insurance based investment account. Over the course of 40 years, that's a pretty substantial difference there. We're talking almost $12 million in net difference, which creates 392% more value in the premium finance life insurance policy at age 89. The question really becomes, are you willing to take an $11.8 million loss by not employing premium finance life insurance into your overall portfolio? But sometimes we still have clients say, I really don't want to pay for this life insurance policy. Well, the reality is incorporating life insurance into your overall estate plan is not a cost per se. It's really an asset reallocation play. Now, what I mean by that is typically you're not going to use your ongoing earned income to fund your life insurance need. You're probably going to reallocate certain assets inside your portfolio. In other words, switching out assets that are less tax efficient for an asset that is more tax efficient. Here's what I mean by this. Let's say you have a $10 million current portfolio account balance. Hopefully that should grow over time. But at end of life, generation 2 is going to get that portfolio balance minus 40% in estate taxes. Now, conversely, you could have the exact same portfolio with the exact same $10 million starting account balance that would grow over time, but you could reposition a small amount of your portfolio value into a life insurance policy. At end of life, generation 2 would obviously get the portfolio balance minus 40% in estate taxes, but they would also get the net death benefit of the life insurance policy. On the right-hand side of the screen, again, we show the portfolio without life insurance represented by the blue line, and the green line represents that exact same portfolio and using a small amount of that portfolio to fund the life insurance policy. And so that green line represents the ongoing portfolio value minus the estate taxes plus the ongoing death benefit value. Over the course of 40 years, again, that is a pretty substantial increase in value by incorporating life insurance inside your portfolio. Now, the last objection I will typically get is someone that says, well, I don't like debt, right? I'm debt adverse. Well, let's take a look at an apples to apples comparison using leverage versus not using leverage. In the financed life insurance policy, there in the green, we see that the total net cost is zero. So if you remember, we did that 100% cost recovery model where you took drawdowns from the policy value and still kept the net death benefit above $10 million at all times. If you were to buy a non-finance life insurance policy, the annual premium for a $10 million level death benefit policy is just over $146,000 per year, and you would pay that annual premium over the course of 20 years, totaling $2.9 million in expense. Of course, there's no cost recovery in the non-finance life insurance policy. And then we have the non-insurance-based investment account. Again, we are recovering the same cost as we did in the premium finance policy, making the net cost zero. If the client were to die in the first year, God forbid, the total payout, meaning the net death benefit of the premium finance life insurance policy, would be just shy of $26 million. In that first year, the non-finance policy would pay a death benefit claim of $10 million, and the non-insurance based investment account would have a value of $88,000. If we go out to year 27 at age 75, The premium financed policy has a net death benefit of $10.1 million. Now, and again, this is the low point death benefit. The non-finance policy obviously would still have a $10 million death benefit, and the non-insurance based investment account, after fees, capital gains tax, and estate tax, would have a net value of $6.79 million. And then if we go out to year 40, that would put the client at age 89. In the premium financed policy, after the 100% cost recovery, that would have a net value of just shy of $16 million versus the non-finance policy at only $10 million, and the non-insurance based investment account would only have a net value of $4 million. Again, that's after the cost recovery drawdowns, similar to the premium finance life insurance policy. To look at the same data just on a graph, again, in the green, we have the ongoing net death benefit of the premium finance policy that has a zero net cost. The orange bars represent the ongoing $10 million level death benefit of the non-finance policy that has a $2.9 million cost. And then the blue bars represent the ongoing net value of that non-insurance based investment account. A pretty dramatic difference. Okay, let's move on to loan model number 2. This loan model we call partial equity interest accrual. And here's how this works. In this scenario, we have the same $2 million annual premium, but in this case, the premium is due for a period of 10 years as opposed to only 7 years. In this scenario, the client pays about a third of the premium out of pocket. They borrow 2/3 of the premium, and then they accrue the interest. In other words, they do not make the interest payments out of pocket. They capitalize those interest amounts back into the principal loan balance. In this scenario, we see a drastically reduced amount of collateral required because we're not 100% leveraged, right? Again, the client is paying in a third, and then they're borrowing 2/3 of the premium. In this case, we can still exit the loan in policy year 11, and we still have the 100% cost recovery component, and the death benefit stays above $10 million at all times. The third loan model we have is called second year financing. In this model, the premium is only $1.5 million as opposed to $2 million. But the difference is we have the client pay the first year premium out of pocket and then start borrowing in year 2. Once the borrowing starts, the client would pay interest only out of pocket in years 2 through 10. And if we look in the gap collateral column, the nice thing is that it is highly unlikely that the client would have to post any outside collateral. In other words, the policy should be able to serve as the sole source of collateral. And we see here in policy year 11, we pay off the third-party lender. In this loan model, mission is still accomplished. We still have the 100% cost recovery component, and the net death benefit stays above the $10 million watermark at all times. Okay, the fourth loan model we have is called third year financing. This is a very alternative method of funding the premiums. In this case, the first 2 years of premium is less than the premiums in years 3 through 10. In the first 2 years, the client pays that premium 100% out of pocket, in other words, non-financed. And then years 3 through 10, they continue to make that same annual contribution, which is 25% of the total premium, and they're going to borrow 75% of the total premium. In this scenario here, they are going to accrue the interest, and as we see in the gap collateral column, again, very little outside collateral needed. Again, the reason why the collateral amount is so much less in some of these alternative loan models is that they're not 100% leveraged. They have equity premiums entering the life insurance contract, and so their loan to value, right, their LTV, is in a much healthier position. In this loan model, we can still exit the loan in policy year 11, and again, mission accomplished. 100% cost recovery, and the death benefit stays above that $10 million required amount. So if we compare these 4 different loan models, the peak collateral is the highest in the first dollar financing loan model and is the least in the second year financing model. We see there down there at the bottom, the third year financing is, again, very, very little collateral, and that collateral expectation doesn't happen until the 10th year. If we compare the initial death benefit amount, the third-year financing model has the highest net death benefit amount at $30 million, as opposed to $26 million or $19 million in the other loan models. If we compare the low point death benefit, again, about the same across the board. The third-year financing loan model has a little bit higher net death benefit at the low point, but it's rather negligible. And then if we compare the total client outlay, the least out of pocket the client would pay is the second year financing model. Again, that's the one where the client pays the first year premium out of pocket and then starts borrowing in the second year. That loan model does have the least amount of net death benefit from the very beginning, but it does keep that death benefit amount above the $10 million low point. Again, in all four of these models, the client is cost recovering 100% of their out-of-pocket expense via the policy drawdowns. Now, there is one more loan model. This is called sixth year financing. In this case, the client does continue to make a level contribution for a period of 10 years. However, there is no interest accrual in this model, and there's no outside collateral required either. In this quick model I'm going to show you right now, we're also going to assume that the interest rates are north of 7% in all years, which is being a little pessimistic. But again, in the spirit of being conservative, we are modeling these interest rates continuing to increase over time, even though that is not what the industry expects. In this particular model here, the client's going to pay a non-finance premium for the first 5 years of the policy. And then starting in year 6, that's where the borrowing starts. The premium jumps up from $475 a year to just shy of $1.4 million a year. And we built an algorithm that calculates how much of that premium the client should pay out of pocket versus how much they should borrow, because that borrowed amount is going to generate a certain amount of interest due. And so the combination of both of those green columns, the premiums that the client pays out of pocket, plus the interest that the client pays out of pocket on the borrowed premiums, is going to equal a total amount over that 10-year period of $475,000 per year, again, over that 10-year period. In this example, there is no collateral needed other than the policy itself, and then we're also going to exit the loan there in policy year 11. We're going to show a portfolio with and without the life insurance, again, using the sixth year financing design. In the blue column there, we start off with a $10 million portfolio value minus the 40% in estate taxes, and we're showing it grow at the same rate of return in this exact same portfolio in the green. The difference here is in the green portfolio, we are drawing down the amount to fund the life insurance policy, and then we're recovering 100% of the costs later on. And by the 40th year, we see a $34 million net value going to Generation 2 using the portfolio with the life insurance. And in the blue there, we're showing the ongoing account balance of the non-insurance-based investment account without any life insurance. Over the course of 40 years, the net value is only $19.2 million. So with all of our premium financing loan models, our goal is to find out which loan model works the best for your unique situation, and also to figure out if using premium finance life insurance is to your benefit at all from a mathematical standpoint. Another thing we do differently at Lionsmark Capital is we have a proprietary backtesting software platform that backtests 121 different historical 40-year periods, to see how different estate planning solutions would perform during times of volatility and during times where you might experience a poor sequence of returns. Now, we like to think of our modeling capabilities and our process as similar to a laboratory that tests the efficacy of different products and solutions. There is literally no other firm in the industry that has this capability. The goal of this proprietary modeling is to mathematically determine whether or not premium finance life insurance is the best solution for your estate planning needs. If the math proves that there are better solutions, we'll be the first one to tell you that premium financing is not for you. And lastly, we also produce a custom client video for you using your actual numbers. Essentially, we provide a video recording of me personally reviewing your specific numbers, and then we upload that video to the cloud, and then we circulate the link to you. So you can forward it to your financial advisor, your tax advisor, anyone you'd like to include, even your spouse. because I don't know about you, but every time I try to explain something to my wife that I'm not an expert in, I end up sounding like a total idiot. But in all seriousness, these videos really make it easier for all parties to better understand how and why this premium finance life insurance solution can be so effective. So you may be asking yourself, what makes Darren Sugiyama an authority in this particular space? Well, I am an 11-time published author. The most recent book I put out this year is Premium Finance Life Insurance, the Key to Effective Estate Tax Planning. This book is available on Amazon, again, in multiple countries. So if you like the concept of using leverage to create the liquidity that your family will definitely need to pay the 40% in estate taxes in the future, a premium financing might be right for you. And due to the fact that your advisor has a strong business relationship with me, they'll be able to set up a Zoom introduction with me personally, and I'll be happy to help you understand what your real options are. So talk to your advisor, and they'll coordinate this Zoom meeting through my office. I look forward to meeting you soon and seeing if one of our solutions is right for you.